keep coming back to you for more. But let's actually invite Amit Mahawar, who's with us. He's analyst and he tracks the consumer durable space at UBS Securities. Amit, great to have you with us here. And of course, Amit joins us from the sidelines of the UBS conference, which is underway. Great to speak with you, Amit, once again, in a different role, different organization. So let's just divide this, right? Let's talk about consumer durables, and you also have coverage on industrial names. Consumer durables really is an area where perhaps, there has been a fair bit of pessimism. I mean, even within consumer durables, you've got to differentiate the white good companies or, the other ones that you have coverage on. So just talk to us a little bit about where valuations are, what stocks do you cover, and what's the view overall that you have?
Hi, thanks. Good afternoon, Prashant. Thanks for having me on the show. So I think on the domestic consumer durable space, in general, apologies, I cannot, as a policy, comment on stock specific, but we do have active coverage on segments like cables and wire, the entire large appliances and small domestic appliances category. Right from the post-COVID period where you had a very strong pent-up demand, you've seen some softening of demand. If you look at the B2C categories, they are underperforming on growth and profitability vis-a-vis the B2B categories, which is more triggered by the infrastructure focus, be it LTHT cables or wires or the new home improvement. So there is a divergence in performance across these two segments. Inflation has been impacting the entry-level consumer, where India is the largest. The category in India is mainly on value segment and first-time buyer that is struggling. And not only electricals and consumer durable, you look at across discretionary, that is the trend, Prashant. On valuations, lastly, I think generally, you've seen some correction in some categories, but in general, the valuations are continuing to be at premium to benchmark Nifty, which has been the case for the last 15, 20 years.
Okay, no, so you like B2C or you like B2B? I mean, you like the Voltas, the AC maker, or you like the pipe maker? Or, I mean, or the wire maker? I mean, what is we're not talking about stocks, but is there an opportunity to make money from here? You think they're fairly valued, both sides?
I think generally, if you look at the cable and wire switchgear categories, which are more channel-led B2B infra, home improvement or infrastructure spend proxies, there the growth rate has been better than what it was in last couple of decades, right? And particularly last 2-3 years. So we like that category. I think that will continue for the current decade. The way government is focusing on infrastructure, you have urban infrastructure trends which are going to continue, driving growth for whether it's underground cable or branded house wires. I think these are categories which will, at least next 2-3 years, I do not see any slowdown in these categories. And on the appliances side, room AC is a category which is still growing in double digits, right, as a sector. You have players which are growing higher than the industry. So there's a consolidation which is going on. You have a supply chain shift from China where half a dozen companies are expanding capacities in India, in the room AC category. That category should do well in general. In the transitory period, you have some overcapacity because demand will take some time to catch up. So maybe around 1 to 2 years, B2B categories will do better than pure B2C. And eventually, you look at the penetration levels across, whether it's fans or whether it's small appliances or large appliances, the penetration is going to be the story for the country, right? So the consuming middle class is upgrading, it's expanding. So that should eventually catch up in the long run.
Okay, got that. So that's a take on consumer durables. Amit, I believe you also cover a whole lot of industrials, in stocks like L&T, I think ABB, Siemens, they're part of your coverage. So I want to ask you what you have made of the kind of earnings that these companies have delivered. I think, if my memory serves me right, I think L&T was great. Cummins was a strong set of numbers as well. Most have been good. But the question is, are these numbers good enough given the run-up in stock prices? Would you be confident, say, advising someone to take fresh positions in this industrial space, despite the run-up, looking at the earnings?
Hi, afternoon, Surabhi. So I think on the industrial space, there are a couple of trends which are reflecting in numbers. If you see the last 1 to 2 years of performance, the urban infrastructure in domestic market is triggering very strong order intake growth in categories like electrification, whether it's low voltage or the transmission range. You have mobility, which is by far the strongest growth, right? India as a country has awarded 15 billion USD worth of mobility contracts in last 12 months alone, perhaps the largest globally. And in the thematic note we came out with earlier in the year, we highlighted the macro industrial trends on the urban infrastructure, which is driving the ordering momentum and capex momentum from the government side. And defense is the third layer, where I think defense manufacturing as a subset is becoming very large. Right, you already had significant imports which are coming down. Right, you have significant exports which are now perking up. So the ecosystem in the defense manufacturing is clearly expanding. So you have electrification, defense manufacturing, and the third layer is industrial automation because of industrial efficiency. And mind you, I'm not talking about the greenfield capex. I don't see that. We don't see greenfield capex too much inside, but the debottlenecking, efficiency, and brownfield capex on industrial. So these three layers, are triggering very strong order intake growth on the long cycle orders. And that's reflecting in the last 8-10 quarters of order intake momentum, which is in high double digits.
Okay, so Amit, just a quick follow-up, and just in terms of most of these companies have very healthy order books, L&T included, but just in terms of better execution, pulling better margins from this order book, what kind of companies are you most optimistic on?
Sure, very valid question. I think if you look at the short cycle businesses, which are more like technology-led product companies, right? Without going into the specific companies, you look at the industrial pumps, motors, and drive companies. You look at standby genset companies. So these are segments where you saw very strong margin trajectory in last 2 years. But the long cycle order book driven companies, again, right, which have a longer lead time, are taking much more time to reflect profitability. The execution has started in the last couple of quarters. And it's always the case. You have order intake momentum, then you have execution, right, which is followed by profit recognition. So I think in the coming few years, you will see profit growth in the long cycle businesses catching up.
Okay, all right, got that. Amit, good chatting with you today. Thank you very much for joining in and giving us a perspective on both of those sectors. I wish you season's greetings. Hope you have a happy Diwali, and we look forward to catching up with you in the coming months ahead. Okay, that's a conversation on industrials and on consumer durables. Let's just go back to Apollo Hospitals for a bit. The stocks, actually, it's